Welcome to the second annual Dorsey and Whitney Construction Symposium. I'm Jocelyn Knoll. I'm the chair of the construction practice group here at Dorsey. Along with my colleagues, we're excited to present this program to you today. We thought we'd do something different this year. Instead of presenting the normal claims and schedule issues and change order issues, we thought we'd actually talk to you about how to grow your construction companies through merger and acquisition, something much more appealing to the C-suite than perhaps dealing with claims. With regard to the program today, what we want to do is hold the questions until the end of the panel discussion. And then if we have to cut it off to stay on schedule, we welcome you to approach panelists on a break or at the end of the program to ask additional questions. I'm going to launch into this today. I was told that I should tell a joke. I'm not very funny. You've already realized that. But I do want to say that, if this program doesn't go well for you today and you have to go back to your CEOs and report that, you don't have any great ideas for growing the company, Donald Trump is looking for a new FBI director, so you might want to submit your resume. With that, I'm going to introduce our keynote speaker, Tim Sznewajs. He's the managing director of DA Davidson Companies. He's going to talk to us today about the outlook for the construction industry with regard to growth and development. Welcome, Tim.
Hey, good morning, everybody. As Jocelyn said, I'm Tim Sznewajs. I'm with DA Davidson and Company. I'm based in Denver, Colorado. We're a national firm, a national securities and investment banking firm. We have practice areas in a number of different vertical markets that we serve. I lead the engineering and construction practice for the firm, and so spend all of my time, and have for really the past 15 years, focused on capital raising and transaction events, mergers and acquisitions of various stripes for both privately and publicly held firms in the industry. So I guess for better or for worse, I think I know what I'm talking about when it comes to our industry and some of the trends and what's happening from a capital standpoint, from a transactional standpoint. And so I'd like to share my thoughts with you. When I was approached by Jocelyn and Robert to present here, they asked me to break my time up into a couple of different areas, and so I've outlined those for you here. The first is really just an overall view of what's going on in our industry. We're at I think a very momentous time in our industry, given the growth that we've experienced, and now, I guess, 4, 5, 6 years, depending on how you define it, out of the downturn. It feels like the past is finally behind us. We've turned the page, and we're focused on a new era for the engineering and construction space overall. I want to talk about the implications of that for valuation in our industry, and so I have some information that I'll present there. And then I'll talk about some of the trends that are happening in M&A. Maybe at my own peril, Jocelyn, I will open it up for questions as we go. Maybe for the panel discussions you want to try and stay on, but I'm happy to take questions as we go here. We have a small enough group where we should be able to manage that. So if there's anything that I've said that you don't agree with or you have a question on, please feel free to ask that, and we can have a bit of a dialogue. And then we can see where that takes us. But let's jump in terms of an overall overview. And I think you all have the slides. Is that correct? Do people have the slides in front of them? Okay, so you can look along. A few of these are a bit of eye charts, so I apologize for that. They may be difficult to read from the back of the room there on the screen, so you can refer to the materials that you have in front of you. I guess from an overall standpoint, so looking globally at the economic situation, and specifically here in the U.S., we're in a good spot. I think it's been a bit of a slow, grinding recovery. We've kind of lurched forward with a couple of intervening government shutdowns and things over the past 4 or 5 years that have caused us to stumble. But overall, we've had 6, now almost 7 years of positive GDP growth depending on who you ask, anywhere from kind of 2 to 3.5%, which is great for the world's largest economy. So the U.S. is in a good spot. The chart here on the lower left side shows you the U.S. unemployment rate. You probably saw the headlines that came out last week that talked about unemployment and where we stand. We've really returned to pre-crisis lows as it relates to the level of unemployment in our economy. So we're down in kind of the low 4% range, which for those of you who've been around for a long time, over the last 20 or 30 years, economists used to think that this 4% level really wasn't even achievable. And now we're back to where we were in this 2005 to 2007 timeframe. So we've added significant jobs. People have come off the unemployment rolls, and certainly in our industry, and we can talk a little bit about that, we're struggling to find people in the engineering and construction space, both qualified administrative and office personnel, project management resources, as well as field resources. My personal view is some of that is a function of just a strong economy, and a lot of it is also due to the fact that we had many folks leave the industry during the downturn in 2009, 10, and 11, never to come back, to be retrained and to be focused in other areas, oil and gas, energy, while that was going on, as well as other skilled trades that have soaked up some of the resources that were otherwise employed in the construction arena. Overall, I think the stock market, which I'll talk about as a proxy for valuation, has also reflected the strength of the economy and the expectations for future growth. And then as it relates to M&A activity, I'll show you the information here in a minute, but in the second half of 2016, overall, the M&A economy took a bit of a pause, I think largely related to the election and the lack of certainty around the outcome that was forecast in November. But we have returned, and the pace has picked up significantly in the first couple of months of 2017 with both announced and closed transactions, as well as just general levels of activity in the M&A market, which I'll speak to. So the engineering and construction space, gosh, I guess the lines are a little light on the chart, but if you look at the upper left-hand side, this is non-inflation adjusted non-residential and public construction spending. So this is expressed in millions. So this shows you the total amount of dollars being spent. You can see roughly $425 billion of private non-res construction. And obviously we had the significant dip in 2008, 9, and 10. What I think is interesting, and again doesn't show up really well on this chart, is these dashed lines show you where we were at the peak in 2006, 7, depending on the time frame for each of the markets, both private and public. So on the private side, we've busted through our pre-crisis levels. So volumes are back. I think more encouragingly for my clients and for those of us in the industry, margins are back as well. So not only do we have significant levels of activity in terms of building activity and bidding and future prospects, but also we have I think relatively healthy margins in the industry given where volumes are at and the relative level of competition for those. The lower left-hand chart shows you the percent change in non-residential construction. So this is more of a growth indicator. Again, you can see the significant downturn, and then the kind of fits and starts. I referred to the government shutdowns at the end of 2013 and again in 2014. So you can see some of the impact that was had in the environment for our industry there, as well as some of the oil and gas stuff that was flowing through in 2014, 2015. But overall, again, very positive growth for several quarters now, running on 5 or 6 years of positive growth. And so those are very significant and encouraging numbers. In terms of some of the specific end markets that we see in the construction market, I think civil construction demand, which again largely publicly funded, has lagged a little bit, but we're starting to see significant levels of activity and increase, both on the mega project side, so projects that are call it $500 million and above, but probably more importantly for most industry participants, that 50 to $100 million, even $25 to maybe $75 million project range, which is the bread and butter for a lot of firms, middle market firms. Very significant levels of activity, both in terms of lettings and future prospects. The other item of note, I think, I don't think many of you have much direct exposure to single-family residential. However, we know that single-family residential construction starts tend to drag additional follow-on construction activity behind them, both in terms of some of the front-end work that gets done, the site clearing, grading, pipeline, utility-type infrastructure that's put in place to support that work. But more importantly, the strip centers, the retail, the light commercial construction that tends to follow single-family residential development is also benefiting from what we see now, which is kind of a 750,000 to 800,000 starts on an annualized basis. Again, pre-crisis, we were pushing over 1 million. I think we were close to 1.2 million of single-family residential starts at the peak in 2006. So the fact that we're back anywhere near those levels, given how overheated the market was during that time, and it seems to be much more healthy given where residential home values are at right now, we see very much as a positive. I guess I should talk a little bit about infrastructure, which is on the tip of everybody's tongue, right, since President Trump was elected. I guess I have personally some questions about how sustained the infrastructure spend will be in this country. Not because there's not a great demand for it, certainly there is, but more so in terms of what is the funding source that will occur. There's been a great deal of talk from the federal administration about public-private partnerships. I guess there's some announcements that are scheduled for the next couple of weeks from the Trump administration on that front. We'll see how things develop. My personal opinion is that the benefit to our industry on a macro basis from the Trump administration is going to be much more in terms of regulatory relief, both environmental loosening and easing of restrictions that were developed over the previous administration's 2 terms, as well as perhaps some relief on the healthcare side and some other labor type laws, which I think will be of great benefit to our industry. Not necessarily new dollars coming in, but perhaps saved costs or avoided costs that will help from a regulatory standpoint. This is, to me, a very stark slide that is to the positive for our industry. So what we show you here are 3 different indices. The green line represents the D.A. Davidson Engineering and Construction Index. This is 25 publicly traded firms that we follow, so AECOM, Jacobs, Fluor, some of the big bellwether names that you would recognize, some of the specialty trade guys like Limbach, Mechanical, Comfort Systems, MCOR, as well as some of the traditional diversified builders like Tudor Perini, Sterling Construction. So we don't have a great universe of public companies in our industry, and there's many reasons for that, but the ones that we do, you can see on the green line their valuations reflected here. The light brown line is a Russell 2000, so more of a mid-cap, mid-market index, and then the yellow or light brown line is the S&P 500. You can see there, election day, November 2016, and the almost immediate bump that our industry received from a public market valuation standpoint, and have sustained that since. There was a bit of a run up and then a run down, but we're still holding at levels that are roughly 20% above where we were in early November of last year. So that's a very significant structural change for the expectations. Public market valuations tend to reflect expectations for future growth, and I think you're seeing that here in terms of how public investors are thinking about our industry, at least the public side of things, and that should likely translate into benefits for most of the rest of the industry, 99% of which is privately controlled firms throughout the United States. I've got some information here on a variety of different construction indicators and data that reflects just kind of growth and prospects for the industry. I won't stop and comment on each one, but I guess I will offer some thoughts. So these are backlog indicators that are from various third-party sources, as well as builder confidence levels. So, these are sentiment surveys, right, where you talk to CEOs and C-suite executives about their view of the future. You can see here on the lower right-hand side the pretty significant bump up in the fourth quarter of 2016 post-election, and then the first quarter of this year. Significant increases in confidence from the executives that are polled by the Associated Builders and Contractors. And then in terms of construction backlogs have held pretty steady. You can see the low point was that 2009 period when the average for the industry overall was kind of in that 5 to 6 months range of backlog. We're up significantly and have been at those elevated levels, kind of 7 to 8 months of backlog for most firms in our industry. That's a very healthy level historically and where we would like to see it. We've broken out some of the data on the upper right-hand side in terms of the different end markets and sectors and where backlog expectations are at. In terms of some other information, the Architectural Billings Index, so many of you are familiar with this. This is a survey of architects nationally broken down into 4 regions. This is the national composite. Anything above 50 is positive, anything below 50 is negative. You can see it's interesting. We've actually been hovering right around this 50 level, although again in the latter part of last year, early part of this year, significant upturn to the positive and pushing well into the kind of mid 50s. Which is a very strong historical level. You can see where things were at in 2005, 2006. So I would say overall positive. The Dodge Momentum Index, which is a combination of really starts plus potential new lettings and prospect jobs that are publicly announced, mostly by public agencies, although there are private owner lettings that are included in this. This has very solid momentum. And then the Manufacturing Index, which is not necessarily a construction-specific or infrastructure-specific index, but gives you some sentiment from standpoint of capital expenditures for heavy industry in our country, which is a significant component of overall construction spend in certain parts of the country. Highway and transportation spending data. So this is a compilation of the actual dollars that are allocated at the federal level under the highway bill, the federal highway bill. We had that bill signed at the end of 2015, so we've now been operating under FAST Act for almost 18 months at this point. The funding is starting to come in as far as projects that are actually hitting the ground, and we're seeing, again, as I mentioned before, solid levels of activity, maybe a little bit below expectation relative to some of the enthusiasm that was coming out of the Trump administration for transportation spending. I think probably a bit of a disconnect between popular sentiment and talking about infrastructure and the reality of what it's like to actually put federal dollars to work into our industry. There's a significant lag there. But given the FAST Act implementation, we've got a 5-year bill with 3 years of spending paid for and identified. So we're going to have another issue in about 18 months where the Congress will have to decide how to fund the FAST Act appropriations that they have at least outlined. We'll see how that plays out against the backdrop of whatever infrastructure plan, this $1 trillion number that's been thrown around by both Democrats and Republicans. Again, just going through some of the subsectors of our industry, want to talk about energy and power for a second. In the 2010 to 2014 timeframe, obviously this was a significant growth area for our industry. This is just the price of crude oil, which is reflected here on the left-hand side. You can see the almost 12-year history, and then on the right-hand side, we've broken out really the last trailing 12 months pricing. I guess the message here from an energy end market standpoint is pricing is relatively consistent at this point, right? A barrel of oil today has settled somewhere in this kind of mid-40s to maybe pushing above the $50 mark. If you pay attention to the Quantas and Maztecs and firms that are significant players in the pipeline infrastructure space and also do a fair amount of midstream gathering and some transmission of energy, both oil and gas, they will tell you that they're seeing capital expenditures start to flow again based on the relatively consistent pricing of energy. So I think everybody in the energy world wishes oil were back at $80 plus per barrel, but are happy with, in most basins, most of the geographic areas of the United States where there's significant oil and gas exploration and drilling activity, can make projects work in this $45 plus range for oil, as well as where natural gas prices are at. Coupled with the regulatory relief and the probably more pro-energy, less environmental friendly posture of the Trump administration relative to the Obama administration over the past 8 years. We've seen things like the Keystone Pipeline receive approvals, though there are still some issues at a state level. We expect to see a more sustained level of energy activity in the months and years ahead. And what I've done here is just broken out. For many of us that don't participate in oil and gas, it's a bit of a monolithic industry. It's not quite clear exactly where and how all this money is getting spent. I've tried to break out for you here. This is information from the Oil and Gas Journal, which does a survey of both past historic as well as future expected spending for the industry. I guess two comments I would make here. Number one is the green line on the top in the upper chart. This is E&P. This is the folks that are out there drilling holes in the ground and actually finding and extracting resources in the ground. So this is the highly speculative part of the industry. When oil is strong, then you see activity when pricing is strong, you see activity taking place, or like we had in that 2008 to 2014 timeframe, this significant technological development around hydraulic fracturing or fracking. You see the activity go up. If you look at the brown line on that upper chart, that's the downstream expenditures. So that's really that's remained relatively stable over time. You can see a bit of a spike up in 2013 and 14. The composition of that brown line, the down midstream and to some extent downstream spending, I've broken out in the chart at the bottom. So you can see there, what is that composed of? So that's pipelines, that's gathering and storage, that's transportation. It's kind of all the other infrastructure that gets put into place in order to support all of this oil and gas activity. There tends to be some lag effect. So after we bring resources online, then we've got to figure out how to transport it, how to store it, gather it, and then ultimately refine it. So petrochemical, LNG facilities are included in here, which we know are moving forward based on LNG export activity in the U.S. And you can see this is relatively strong. This is a $60 billion market in the U.S. in 2017 and expectations for growth beyond that. So again, healthy levels of activity even across the energy sector. If we look on the next slide, what I've done for you here is tried to capture backlog, publicly stated backlog and profit expectations for, again, the 25 firms in the D.A. Davidson Index, the publicly traded companies in our industry. As you would expect, public company CEOs and CFOs are universally optimistic and upbeat to the investment community consistently. So this is doesn't necessarily give you a lot of new information, but what you can see is from a top line standpoint, an expectation for growth for public companies that's pushing high single digits on the top line for revenue, and then almost 6% compounded annual growth rate on earnings. The numbers are actually a little bit higher if you just look at that 2016 to 2018. So if you looked at the estimates, the earnings estimates for the public companies in our industry, you would see that most of them have taken expectations up pretty meaningfully, kind of 15 to 25% across the board over the course of the last 6 to 8 months, based on a lot of the chatter and expectation in the market as it relates to backlog and future spend. So that's a bit of a tour around the industry and a broad look at the different segments of our construction economy and where they're trending at today and where they're focused on going forward. I would say almost without exception, universally positive, which for those of you who have been through a cycle or two, is maybe time to be a little bit nervous given how everyone is focused on blue sky and optimistic outlooks. But we'll go with it for the time being. I want to spend a couple of minutes on valuation. And again, I know most, if not all of you, are privately held companies. So, why the focus on the public companies? They're really the only proxy that we have that's anything that's consistent. So most of the work I do is also with private companies, and I'll speak to private company and private company valuation here in a minute. But again, from the standpoint of wanting to present data that is fact-based, we have to rely upon the public companies in the industry for some of that. So this shows you, again, this 25 company index that I've referred to multiple times, this broad-based index of the public companies in our industry. Again, most of them very large, the bellwether names, but there are also several small and mid-cap firms that are less than $2 billion in revenue and certainly less than $1 billion in market cap. So not necessarily horrible proxies for what we're talking about today. This shows you enterprise value as a function of forward EBITDA, earnings before interest, taxes, depreciation, amortization. So a quick proxy for free cash flow. So the value of a company expressed as a multiple of its next year future expected earnings. You can see here the dashed line gives you this representation. Our industry over the past almost 12, 13 years has been right around, from an average standpoint, just a little under 8 times. So the average is actually 7.8 times enterprise value to forward next year earnings. You can see a little bit of the impact of the cycle and the fact that we're actually trading, even with that 20+% bump that I pointed to on the previous charts in valuation, in overall valuation of firms. You can see that while the valuations have gone up, again, the earnings expectations for the public companies in the industry have increased as well. So, we're hovering right around this 8 times mark for the industry as a whole. So I don't think we're overbought. I don't think we're in a excessive valuation time frame. I would say, relatively speaking, we're in a pretty normal place in terms of how the public markets are valuing the publicly traded companies in our industry. This is certainly an eye chart, but I think does have some interesting information. So what I've tried to do is break out these 25 companies into some composite sectors. You can see the 6 sectors that are highlighted here: environmental, utility, general building, civil, diversified, which is a bit of a grab bag, and then the pure oil and gas players. Now, if you look, you'll see this isn't entirely representative. For example, in the environmental sector, we have AECOM and Stantec. Are those really pure environmental firms? No, but they do have significant environmental component to what they do. Tetra Tech, I would argue, is probably the best pure play environmental firm. But nonetheless, those are the sectors. I think they're still representative. Each of the sectors has really, I guess, 5 data points on them. On the on the left-hand side, you see that's the left and right-hand side. You see the 5-year maximum and minimum valuations. Again, this is enterprise value. This is actually trailing last year's earnings, so this is a slightly different statistic than the previous slide, so that's why the numbers don't match entirely. But you can see kind of the goalposts of where valuation has been over the last 5 years. The triangle, both the light and the dark triangle, represent respectively. The light triangle is the 3-year median for that peer group of where they trade, and the 5-year is the darker triangle. And then the green dot is where are we today. So I think the important takeaway here is for each of these sectors is the green dot relative to kind of the goalposts as well as the 3- and 5-year averages. And you can see, with the exception perhaps of civil construction, all of the current trading ranges are in excess of the averages. So again, reflecting the momentum in the marketplace with a 25+% uptick in valuations for the public companies, you would expect to see this. You can see here And to have building firms, general building firms that are trading at 9.5, almost 10 times earnings, those are relatively healthy levels. You can see the 5-year peak is 10.4, so we're approaching that. But again, generally speaking, things are solid from a valuation standpoint on a diversified basis. If we would have shown this to you a year ago or 18 months ago at the bottom, the oil and gas would have been pinned far to the left. So even expectations for earnings growth for those firms that are providing infrastructure services to the energy industry have recovered pretty meaningfully over the course of the past 18 months. In terms of, translating this to private company M&A, I want to spend a minute talking about what are the value drivers for firms in our size range when we're looking at privately held middle market companies. What are the things that really drive value? Obviously, public companies, there's a different set of metrics. What we've tried to do here is extract for you those things in our experience, having brokered numerous transactions in the industry, the characteristics and attributes of companies that tend to lead to either lower or higher valuations. Certainly, this isn't a valuation seminar, and I've actually presented this information and taken a couple of hours to do it, so I'll just hit the treetops from a valuation standpoint. These first couple of bullet points are just really, I think, applicable to almost any company in any industry, which is, do you have the requisite level of size and scale? Do you have some geographic diversity? Do you have some customer diversity so you're not highly dependent on one end market from a geographic standpoint? Size and scale, we're not necessarily dependent on one key individual for an organization. It's more of a business as opposed to an entrepreneur, owner-led, that's highly tied to the activities of one or two key people. So that plays a factor. Some of the on the left-hand side, some of the things I want to focus on. I mean, at the end of the day, end market served is very important in terms of we are more or less in the engineering and construction marketplace, tied to kind of GDP plus or minus a little bit, and then really to those end markets. None of our markets, for the most part, trend too much in excess of that, right? We tend to see kind of single-digit growth. Now, there are exceptions to that, but the end market that you serve and the growth expectations for that end market, as you would expect, have a significant impact on valuation. If you look at what's going on right now, for example, in the telecommunications infrastructure space, the significant amount of both fiber and wireless construction activity that's being put both into the ground and into the air in order to support. We're seeing growth levels that are double digits in some geographies, triple digits. Kind of 100% year-over-year growth in expenditures to support this massive explosion of data consumption by individuals and businesses. And so, that's an end market that for us in an M&A environment is very, very attractive right now because of what's happening in telecommunications infrastructure. But for the most part, we tend to be, we're building roads and bridges and commercial buildings. While cyclical, we tend to be tied very much to those end markets. Some other things that we look for when we're working with businesses and trying to assign values: barriers to entry. Is this a bid market? Is this something where anybody with a bond and a qualification and a license can put a price in? And so there's going to be a cap ultimately on profits that can be earned in sectors like that, because they tend to be very price competitive and revert to the mean, especially in times when volumes come down. Or are we in more of a protected market where there are specific qualifications that need to be earned over a period of time, or a resume is very important, where there are ultimately awards made that are based on more than just price. So creating those barriers to entry and allowing a business to be able to earn outsized returns from a profitability standpoint relative to the overall industry. A big piece of valuation in our industry, frankly, is this second to last bullet point on the left-hand side: the quality and the ongoing commitment of management. At the end of the day, really, in my opinion, most engineering and construction firms are people businesses, and there are key folks within every business that drive value, both in terms of their ability to identify market trends and opportunities, the relationships they may have with owners or with subcontractors, or if you're a sub, to the generals, to be able to generate opportunities, the concentration of really risk management that exists at both the project selection and project management level. That, if you think about it, within most businesses is usually driven by a couple of key people. What we see in an overwhelmingly privately held industry like engineering and construction is most of the time when there's a transaction that's contemplated, that's an exit transaction for the significant shareholder, right? So the individual, he or she, who's reached an age when they no longer have the appetite for the risk or don't want to be involved in the business, they look to a third-party M&A transaction as a way to get liquidity for their holdings in that company, which is usually a very significant component of their net worth. What's the value of that company when that key individual is looking to retire 6 months, 12 months, 18 months after a sale of the company? Do we have systems and processes that are repeatable, or is this a business that's based on one or two key individuals? So even at very large enterprise values, we tend to spend a lot of time as investment bankers when we're either facilitating a sell-side transaction or working with buyers to look to conduct M&A activities at the quality of the management and that ongoing commitment of management. There are a number of other things on the right-hand side which are pretty market-specific, right, to our industry. Are we doing a lot of negotiated versus bid work? So do we have some flexibility on pricing? Are we in a design-build or design-bid-build world? How much of our work is bonded? How much of our work is direct-to-owner versus subcontracted? How valuable are we as an enterprise to ultimately the entity that is spending the dollars on the project? And are we disintermediated as a subcontractor, or do we have that direct prime relationship that has an outcome and a driver on value? And again, one of the things that I mentioned before is this, again, on the right-hand side, second to last bullet point, a consistent and a disciplined approach to how you manage work. Those processes and systems around project management that really keep us out of trouble as contractors, either in terms of project selection or in terms of when we get into a job situation, managing risk within the jobs. A lot of this business is about managing losses, right? The easy jobs, the high-margin jobs tend to be perhaps a little bit easier because of the way that they were procured or because of some unique way that we have of, from an engineering standpoint, approaching how we're going to build the work that gives us a competitive advantage. In my experience, the firms that are able to manage their downside risk on projects where they don't have a lot of those big loser jobs that can blow holes in your income statement and balance sheet are the ones with that consistent approach that tend to yield the higher levels of valuation. Now, in terms of a question that some of you may have, which I always get at this point in the presentation, which is, okay, so what are the multiples? How are private companies valued in today's marketplace? I'll give you a really wide range, and then I'll drill down on that in a little bit more detail. The wide range is, call it for contracting businesses, construction companies, on the low end, 3 times earnings, on the high end, 7 times earnings. So a couple things there. When I say earnings, what do I mean? For most of us, for privately held construction businesses, if we're an S Corp or an LLC, a pass-through entity, that would be pre-tax earnings, so operating income or pre-tax earnings. The public companies that I was referring to, some of the valuation metrics, I talked about EBITDA, right? So EBIT, operating income, earnings before interest and taxes, and then D&A, depreciation and amortization. It depends, frankly, if you're going to get credit as a seller for your add back of depreciation. If I look at, for example, a very equipment-intensive civil contractor, for example, maybe somebody that's doing a lot of land development, site clearing, for example, it's an equipment-intensive business. I've probably got, if I'm a meaningful business, some meaningful percentage, 15, 20, maybe 25 or 30% of my earnings, I could boost my earnings by that much if I add back depreciation, right? Because I've got all this equipment and iron that I'm out there using and depreciating. Well, if I turn over to the cash flow statement and look at capital expenditures, what we'd see is that we're usually spending an equivalent amount of CapEx to replace that equipment. So that depreciation that I'm trying to get credit for, the EBITDA, the D in the EBITDA add back, is usually being consumed by capital expenditures. And so if you have an equipment-intensive business where you're spending significant amounts of capital to replenish and build a fleet to support your operations, then we tend to see that buyers will not necessarily give you full credit for that depreciation number. But nonetheless, 3 to 7 times market. So what tends to drive those valuations in addition to these characteristics? So 3 to 4 times on the low end. That's usually very small companies. By small, I mean probably less than $15 or $20 million in enterprise value. These are businesses that tend to be very owner dependent. So key man risk. At that size, many times customer concentration is an issue, geographic concentration. We're probably a pretty cyclical business at that point. So, 3 to 4 times, that can be compelling for some owners, but a lot of folks look at that and say maybe not motivated to transact. I would say where most deals get done in our industry is in that 4 to 5 times earnings range. If you think about it, if you ran the financial model and looked at spending 4 to 5 times on a business, that equates to roughly a high teens, low 20% IRR. And that's if we look at returns on capital in our industry mostly for privately held businesses. I think most business owners shoot for that kind of high teens. In today's market, maybe we're looking at more like high 20s, kind of 20 to 30% pre-tax return on equity, right? That's a pretty good number for our industry in terms of where most private businesses are at as far as returning capital relative to the assets or the equity that's employed. So that 4 to 5 times is pretty consistent with that in terms of a return on invested capital. We do see, as I say, transactions. There are instances where things will trend up to kind of 5, 6, 7 times businesses. We see those. They have many of the characteristics, the attractive characteristics that you would see outlined here. So places where I'm seeing those types of valuations today, utility infrastructure, both telecom, as well as electrical, T&D, substation, anything kind of utility oriented is being valued pretty strong if it has any size and diversity to it. Another segment of the market that's been pretty consistently valued on the higher end of the range has been industrial services. So end market are petrochemical, refinery, other manufacturing processes that have oil and gas as a feedstock, and the services surrounded those. That's largely sub-trade, more labor-based businesses. Some EPC businesses you'll see trade in that range, but when I'm talking about industrial services, I'm thinking about things like scaffolding, painting and sandblasting, coating, industrial cleaning, mechanical, electrical, again, into the industrial sub-trade environment. Those are examples of where you start to see valuations in that level. But you should really think about 4 to 5 times as kind of the normal. I'll talk in a minute about structure overall. The final section I want to cover is just kind of M&A activity in general, both across the economy and for our industry. So this is some good data actually on just overall middle market. This is not necessarily E&C industry stuff, but just kind of what's going on in the broader economy. The one point I would make here, just in the interest of time, is on the lower right-hand side. So I'm sure most of us, if not all of us, are familiar with private equity, right? These are these pools of capital that are controlled to make investments into privately held businesses. The interesting trend that's illustrated on this chart is the green versus the brown bar and the composition of the green rising over time. This is add-on investment. So, 15, 20, 30 years ago, the buyout shops, it was really all about financial engineering, right? I can use a little bit of my money and a lot of somebody else's money, leverage or debt in order to purchase companies. And I create a lot of value for equity holders because I use the cash flows to pay down the debt, right? Much like most of us buy a house using a mortgage and then paying that off over time and create a tremendous amount of equity value through that process. What has happened as private equity has become more and more competitive, and it's happening in our space, frankly, is in addition to this financial engineering, that is this use of leverage combined with equity in order to fund acquisitions, is firms are reaching down and doing what are called these add-on acquisitions. So I'll buy a platform business, that is a stable business with a management team, and then I'm going to go out and do a bunch of little tuck-in or add-on acquisitions that are going to add complementary capabilities. And what you see in the marketplace is where these smaller businesses are acquired that maybe have a couple $1 million of EBITDA or up to kind of 5 to 10 million of EBITDA, and these little tuck-ins that are done around them. While businesses that are able to achieve kind of $20 million plus of earnings in the private equity environment, in an M&A environment, actually get a lift in multiples that they trade at. Again, size, scale, diversity drives a lot of that. So if I can buy a business that's a single-digit EBITDA business, I can pay maybe 5 or 6 times for that, and then I can do little tuck-ins for $1 million or $2 million of EBITDA here and there. I pay maybe less than that. Maybe I pay 3 to 5 times earnings for those. Kind of mash it all together. Hopefully I can integrate this stuff. I've got it operating on a synergistic basis. Get it to 20 million, I start to see multiples expand where people are willing to pay 6, 7, 8 times EBITDA, simply because the business has more scale and scope to it. And you can see here, add-ons in terms of private equity activity have gone up from roughly half or 54% to almost 2/3, 64%. Of all the activity is this add-on activity that private equity firms are doing in order to build out their platform businesses. The implication for all of you, if you're buyers out there in the marketplace, is you're now seeing private equity compete for much smaller transactions because of their desire to do these add-ons. And so the market has gotten more competitive. It hasn't necessarily translated into significant bumps in valuation for these smaller firms, but what it has done is it becomes harder and harder for a buyer to source a proprietary transaction where there's no competition with other buyers, because firms are aware of this and there's enough liquidity at this lower end of the market where deals are more sought after by a greater number of buyers, and then therefore just making it more challenging to get deals done for buyers. This next slide shows you activity in the engineering and construction space overall. From an M&A standpoint. So on the left-hand side, you see overall levels of transaction activity. So this is North America, this is the US and Canada, and this is both construction materials as well as engineering and construction. So construction materials is the Lafarge, Summit, Martin Marietta's of the world, right? This is sand and gravel, to some extent ready-mix asphalt if it comes with some materials. That's the brown line at the top of the chart. The green line is traditional services businesses, both engineering as well as contracting firms, construction firms. And you can see here, again, that dip that I talked about in the second half of 2016 in the M&A world, and then a return in the first quarter of 2017 to more sustained levels. I would say right now the market for engineering construction firms from a third-party M&A standpoint is healthy. I've got some comments on some specific trends. And then private equity activity, you can see here, represents usually somewhere between kind of high single digits to mid double digits, kind of 8 to 15% of all transaction activity in our industry is private equity. That's actually fairly low. If you looked across other industries, what you would see is private equity tends to represent probably more like 30 to 40% of M&A activity. And there are specific reasons, but mostly it's risk, it's bonding, it's relatively low earnings margins as a percentage of revenue that tend to drive private equity to not have an interest in our industry. There are pockets of our industry where private equity has been interested, but overall, it's a lot of strategic activity. One construction company buying another, one engineering firm buying another, not a ton of private equity. A concept I guess I'd like to introduce and focus on is just the impact of the cycle on transaction activity. We are a cyclical industry, no question. I think the last 10 years have certainly demonstrated that, and I'm confident the next 10 years will also prove that out. And so a lot of the activity that we see, the conversations we're having with management teams, boards of directors, et cetera, around their strategy is really trying to get that crystal ball out and look into the future. Over the course of the next 3 to 5 to 7 years, that investment horizon, what are our expectations for growth, and ultimately, where are the opportunities in our industry? This is our view. This is D.A. Davidson's view of kind of where we're at. If you break down some of the end markets, certainly oil and gas and mining, these commodity-driven, are on the tail end of getting through their downturn and hopefully starting to emerge back to a more normal environment where you see rising commodity prices and consistent demand. You can see here, I've taken some flack for this in other discussions where we've got private non-residential positioned on the cycle curve. I don't assign any length or duration to this cycle, so but I think it's fair to say that in terms of the private non-residential market, I think we're more towards the later end of the expansionary cycle than we are towards the beginning. Certainly not making a call, and I think in many markets it's a very healthy environment. But those areas where we have a lot of room to run are those kind of lower center left. Certainly public infrastructure, I believe, primarily transportation, both surface as well as rail, aviation as well, are very well positioned. And I think there is a sustained level of infrastructure spending that's coming, not just because of what's happening at the federal level, but more importantly, just traditionally, this is publicly funded work. Public tax rolls, we know, tend to recover later in the cycle as housing values and other drivers of municipal and local tax revenue start to recover and come into the coffers of public agencies. So there's, I think, going to be a sustained level of spend in that arena. Government services of all stripes, both construction as well as just outsourced services for government. And then on the energy and power side, pipelines, other transmission storage facilities, as well as electric transmission distribution. The amount of dollars that are being spent to support both alternative energy, right, all the wind and solar that's being built in our country and being brought onto the traditional grid. There's a significant amount of money there. And then just some FERC rulings over the course of the past 6 to 8 years that have mandated additional spending as the transmission distribution market on an interstate level has largely been deregulated, have driven an increased and sustained level of spending there. So then finally, I've got about 8 or 10 minutes left. I don't want to talk specifically about where is the activity, and then I'll touch on 1 or 2 closing points. You can see here, so these are notable transactions in our industry. These are, I guess, for lack of a better term, most of them mega transactions, that is transactions that are several $100 million in enterprise value up to multi-billion-dollar transactions that have occurred. So we had this very interesting peak level of activity that was taking place in 2014, early 2015. So this was largely design engineering firms, and actually if you go back and look at the earlier parts of 14 and even back into 13, right, this consolidation, this massive consolidation that's taking place amongst the large engineering firms as they try and reach scale in our industry, and really a race to the top from a size standpoint. AECOM URS is a great example of this. The growth of WSP, Genevar, which 5 years ago was a couple hundred-person engineering firm in Canada. Today owns Parsons Brinckerhoff. They have done several other transactions, as you can see here, MMM Group, as well as another transaction that's vaulted them into the top 20 in our engineering and design providers. And then a little bit of a lull, as you can see, in 2015. And then really in the first part of 2017, a return to some of these very large transactions. So SNC Lavalin, WS Atkins is the latest for these firms to tie up. The announcement was made in, I guess it would have been in early April. It leaked and then was confirmed by both companies a couple of weeks ago. So this is almost a $2.83 billion deal, financed both by debt and then an infusion of equity into SNC by one of the large Canadian pension funds, which has continuously given these Canadian engineering firms a relatively inexpensive and consistent source of capital to facilitate their acquisitions. TRC, which was a fair to middling performing engineering, a mid-sized engineering company, public company, taken private by New Mountain Capital in a transaction valued at almost $700 million that was announced a couple of weeks ago. Now, these multiples are not all representative, I guess, in specifically the New Mountain Capital TRC deal. That shows a 14 times valuation. That's really based off of underperformance. That's LTM, last 12 months in 2016. If you look at it on a forward basis, it's about 9 times earnings. So, very elevated levels, whereas we all had our jaws dropped in 2013 and 14 when we saw these deals getting done at kind of 7, 8, 9 times multiples. We're now seeing multiples pretty consistently, again, for larger, publicly traded, in some instances, engineering and design firms, not necessarily construction. There's not a lot of contractors on this list. I'll talk about 1 or 2 of them. Most of these are engineering and design firms, starting to push 10, 12, even 13 times valuation. So in some ways, almost overheated. The two contractors I would mention, or 3 actually, CB&I's capital services business. This is really outsourced industrial services. This was a divestiture, corporate divestiture, take private. Lane, which is a $2 billion civil construction firm based on the East Coast. It also has a meaningful amount of construction materials. That was a very significant, $400+ million transaction that was done at an eye-popping multiple greater than 10 times. This is a civil infrastructure contractor. And then Limbach, a mechanical contractor. I think they're number 12 on the ENR list, about $425 million in revenue. They went public through a reverse merger with a SPAC. That is a blank check company. And that deal valued Limbach at the time at 5 times. Their business today is trading in kind of the 8.5 to 9 times range. I'll skip over the market valuation by end market. I've touched on some of that. Talk about some of the themes, and then I want to hit on 2 points, Robert, that you had asked me to address. You can see here, as I say, mega transactions have returned. So we are in an environment right now where very large deals are getting done. I think there's lots of strategic reasons for them from a financial standpoint. I think many companies are taking the perspective that now may be the last window for some very cheap, inexpensive financing as the Fed looks to raise rates and interest rates increase. So access to capital is driving some of this as well. Overall, we're in an environment in the engineering and construction marketplace where consolidation is just kind of happening. And it's happening because we have a very disparate, diversified set of small companies that serve our industry. And in many ways, scale is a benefit in today's market. The ability to attract people, to have world-class HR practices comes to companies of scale. The ability to invest in technology, things like BIM, prefabrication, modularization, things that are of great benefit to owners and finally starting to come into our marketplace. It's much easier for firms that are mid-size or large than those that are small to be able to invest in those types of things to benefit their customers. There's a great deal of what I would call, kind of very specific information on transactions that have occurred. So I wanted you to have that as a benefit in terms of the deals that have happened by subsector. I won't go through that. Private equity investment in our space, you can see some of the trends there. The last 2 items that I wanted to focus on. One is, why would a firm engage in M&A? What are the drivers for that? The things that I see overwhelmingly in our space, that is, why do firms undertake? And there are no slides in the presentation on this. I guess there's really, I would put it into 4 buckets of why firms choose to engage in merger and acquisition activity. One is to get into a new geography, right? We don't know anybody locally. We don't know the subcontractor community. Maybe we don't know the labor environment very well. We certainly don't have owner relationships, but we know that if we're sitting in geography A, geography B is a higher growth environment, we want to move to that environment. So a transaction we were talking about the other day, Tudor Perini's acquisition of Lunda Construction here locally is a great example of somebody wanting to come in and get exposure to the upper Midwest and the heavy civil transportation, really bridge infrastructure market. To get access to a new vertical end market. So a good example of this, Skanska, the large multinational firm, acquired a business in the Midwest called Industrial Contractors, Inc. They're really an EPC and industrial services firm. Skanska, obviously known for both general building and transportation, doesn't have an industrial construction heritage. This gives them the ability to really understand and have credibility with owners, as well as develop a base of projects through the ownership of that. An interesting one, I think one that we'll actually see a lot more of in the next few years, is as delivery methods converge, right? And we have more design build, more EPC, more P3, is firms integrating so that design and build come together. AECOM purchase of Tishman Construction, or of Hunt, which was a $2 billion sports stadium and large institutional builder, is an example of that. And then finally, to gain scale is the fourth reason. So an SNC W.S. Atkins is an example of that, where bigger truly is better. So those are some of the reasons why firms engage in M&A. And the only other comment I would make is, why not to engage in M&A through my experience. A couple of things. One is when we have excess profits. So gosh, we just had a great year last year. We made a bunch of money. Let's go spend it on an acquisition because we've got money burning a hole in our pocket. Generally not a good time to do acquisitions, or not a good reason, number one. Number two, a search for people. Well, we don't have enough people to do our work, so let's go buy another firm because that will give us access to resources. I suspect that most of those targets are equally tied up generating their own business, and that there's not a lot of slack in those businesses. That's not necessarily a good reason. And then finally is what I would call E&R-itis. So those firms that have the desire to climb the charts, kind of growth for growth's sake. We want to get bigger because we think that's better. Will provide a higher profile to our business in the marketplace or with our customers. Growth just for growth's sake, or certainly achieved by M&A, is not advisable either. I guess as an M&A professional, I probably shouldn't be spouting that off in front of a group of people, but those are some of the observations I would have. So my time is up, so I would like to wrap up. I appreciate your attention during this. I'm going to hang around through the duration of the event and look forward to speaking with you. Thank you.
Thank you, Tim.